Good afternoon, ladies and gentlemen, and welcome to the Van Elle results presentation. To start with, if we could cover a couple of housekeeping items. Before we begin, we would like to submit the following poll, which you will see on your screens. Throughout this presentation, investors will be in listen-only mode. However, questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen, or if anyone has dialed in via vanelle@walbrookpr.com. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where appropriate. These will be available via your Investor Meet Company dashboard. Finally, we would like to remind you that this presentation is being recorded. I would now like to hand over to Chief Executive Mark Cutler and Chief Financial Officer Graham Campbell. Mark.
Thank you, Tom. Good afternoon, everyone. I'm going to run through a few opening comments and then Graham's going to talk through some of the financials in more detail, very much in the same structure that we followed in previous presentations. And I think the first thing I want to say is how pleased we are with the results that you've seen today. I'm hoping you can all see the screen clearly enough. We're pleased with progress, satisfied with the results, but most importantly, very pleased with the progress we're making towards the medium-term objectives in the company, and we'll come on and talk about those in more detail. But in summary, record revenues. We've seen a bounce back in all sectors since COVID. If I'm honest, revenues have exceeded our aspirations and expectations at the start of the year. So we're very pleased, but also pleased to see them being sustained into FY23, which we'll no doubt touch on later on. And a reasonable level of profitability. I'm not getting overexcited. It's just the first step of several towards the margin aspirations that you'll be familiar with, the 7 to 8% operating margins that we've set out. So some way to go, lots to do. I don't even think we're at half time yet. But to help us get there, some of the framework awards that we've announced are small game changers, really. Very important strategic steps forward, and give us confidence in the forward-looking revenues and profit streams that come from the higher margin works that we often talk about. And for example, we listed there the Smart Motorways Alliance, which is a 10-year program. The company's never had a framework of that shape or size at all in its history. Huge opportunity for us. Plus the first of the electrification programs that we've also been banging on about in previous discussions. The Core Valley Lines in South Wales going well on site, and we will be starting before the end of this financial year works on site on the Transpennine route upgrade that we announced just after the period closed. All very important steps forward, and they go hand in hand with the improved performance, the stronger management team, the better controls, the deeper customer relationships that we've been working on. We do face some headwinds. We'll probably talk about this in more detail. The supply chain landscape is still challenging. Good news is we don't rely on subcontractors very often at all, but we do rely on materials. We see a lot of price fluctuation. We're all aware of inflationary pressures. We have had and we have absorbed in the year significant disruption on supply, particularly of ready-mix concrete, and long lead times for steel, or indeed concrete, actually, would you believe? Sometimes we've had to give over a month's notice just to order ready-mix concrete. So all in all, the result is pretty good. But more importantly, it demonstrates a trend of hopefully increased confidence in what we're doing. And we've built up, I think now, a good solid platform for kicking on to the next level, and then the next level after that. We've got a very good CFO and finance team in post who have made sure that we've got plenty of prudency in our numbers, as we should have, and we didn't always have that in the past either. So I'm going to, rather than steal Graham's thunder, I'm not going to sort of repeat some of the financial headlines, because Graham will do that now if we turn to the next slide. Thank you.
Thanks, Mark. I'll maybe just touch on the dividend point first, which was the last point in the results overview, and I suppose it's really pleasing to be able to get back to the dividend list at the end of this financial year with a proposed dividend of 1p recommended. So as we've looked overall at the future opportunities for the business, and knowing that there are multiple growth opportunities out there, we thought it was important to start, as we get back onto the dividend roll, with a sensible and modest dividend, probably looking across the market at other competitors and peers at the lower end of the sort of profit distribution and at the higher end of the dividend cover metric. But given that we've had 2 very light years of capital spend, I think it's important that we distribute sensibly, but it also equally important that we get back onto the dividend list again. In terms of the income statement overall, as Mark's mentioned, record revenues, and really pleasing to see those bounce back as strongly as they have done. This is across all of our divisions, and certainly in the final quarter of the year, we saw all divisions operating at extremely high utilization levels, and very busy indeed, with a good strong order book carried forward into FY 2023. Gross profit margins, you'll see there from the table, have increased period on period, and that's really because we've had better utilization of our fleet. That obviously adds some efficiency benefits back through to the gross margin. We've executed better on contracts, and that's helped to push margin up. But the challenges that we faced, as Mark mentioned, have been around the supply chain, mainly supply chain and other inflationary pressures. And I suppose we've seen those around twofold on raw materials. One is the lack of availability at certain times, and that's typically, as Mark mentioned, ready mix concrete, but also steel. And then the price increases. We take steps within our contracting approach to pass on those costs as far as possible, and we've been relatively successful in doing so. Of course, on longer term contracts, that's not always possible, and so there has been some margin impact. And of course, the lack of availability also leads to some disruption in contract delivery, and that's hit our margins as well. In terms of other inflationary pressures, you'll all be very familiar, I'm sure, with the press. We've got fuel price increases which hit us as well, and also wage increase pressures as well, with high demand for our highly skilled operatives in particular, but right across the board, high demand for our people. So we're having to make sure we take steps to retain our people, and that of course puts some cost pressures on board. The profit and loss is clean this year, and by that I mean that we've reallocated share-based payments into underlying profits. We did that at the half year, and consistently continued with that at the end of the year. And so at the moment, the current year has no net non-underlying costs in the year. Now, to be completely transparent here, we have 2 what we would classify as non-underlying items, but they're net off to broadly nil. One is that we have reduced the estimated provision for the earn-out of Screwfast. So you'll recall when we acquired Screwfast, it was part payment up front and then part earn-out and deferred payment later, 2 years later. And we formed a review of the estimate and brought that provision down. And that's been offset by, so that's a benefit to the P&L, but that's been offset by 2 warranty claims in the period. These are very unusual. They're on housing sites where ground conditions have either moved or changed from what we expected, and several years ago that we've started to see some challenges on those properties. We've made sure that we don't carry any bad news into FY 23, and therefore have provided accordingly against those risks. Those 2 items broadly net off to nil, and leave us in a position, as I say, with no non-underlying impacts. The table at the bottom just describing EPS, I won't go into detail unless anyone wants to ask a question on it, but effectively we've presented our EPS as an adjusted EPS number, which is 2.7 and broadly in line with market expectations. The basic EPS is 1.7, and that has been impacted by a restatement effectively a recalculation of our deferred tax liabilities. So a non-cash tax impact as a result of the future corporation tax rate increasing from 19 to 25%. And that government policy means that we have to revalue our deferred tax liabilities. And the impact of that is effectively a 1.1 million tax charge in the year. As I say, non-cash, it's just a revaluation that we need to take through the books at the end of the period. A quick run through the three divisions. General piling, you'll see there, 43% revenue growth year on year, and a good healthy return back to operating profit following a modest 0.3 million in the previous year. Delivered on some really strong and large contracts, particularly good progress in London. And we've talked about this before, but having a strong experience in deep CFA piling and a couple of projects down in the city have been delivered in the period. General piling is the division that typically has the highest proportion of raw materials, and therefore it is the division that suffered the most through those supply chain challenges that I referred to a couple of minutes ago. Another area we're particularly pleased with is rigid inclusions, a ground stabilization technique that we've developed alongside our vibro capability. And rigid inclusion sits within our general piling division. So from an almost standing start a couple of years ago, this has developed into, in FY22, a 3.1 million turnover business. And the outlook for FY23 is strong and increasing, and potentially 5 to 6 million would not be unreasonable to expect in the current financial year. So really pleased with how that's performing. In terms of gross margins, that's sort of early to mid 30%. So a good positive self-help initiative there in terms of expanding our already broad capabilities. And pleasingly, a strong order book carried into FY23. We announced in our trading update a large contract in the energy sector that was booked shortly after the year end, and that's now we're well underway with delivery in that contract. Specialist piling and rail, you can see there very strong revenue growth. Specialist piling in particular, as we've talked about in previous presentations, recovered very quickly after the early impacts of COVID and has operated at near capacity, certainly right through FY22. This division does benefit from approximately 7.5 million of revenue from Screwfast, and we've built the Screwfast acquisition into this division. Screwfast is now fully integrated into the specialist piling division, and we're sharing those resources. We're achieving synergies through back office benefits, and the broader operational teams are supporting site delivery of contracts right across the combined Van ELLE and Screwfast teams. So we're really pleased with how that's going. Again, in terms of expanding our capabilities, we've also increased our capability now into sheet piling, which we talked about at the beginning of last year. And again, pleasing to see some of that come through with a large contract on the A40 in Wales completed in the year. And similarly, again, we've talked about this before, but the rail ancillary civils capability. So that's about performing civils work beside the track alongside what we ordinarily do within the rail division. And the rail recovery, which was, as we talked about at the interim period, rail was relatively subdued in half one of the financial year, but that came back very strongly in the second half. And I'm pleased to say that's continued right through and into FY23. We're seeing much better levels of demand. We've started piling work on the Coal Valley Lines electrification work, and as Mark mentioned, the framework around the Transpennine route upgrade bodes well for future workload as well. Ground engineering services, our housing and strata geotechnics, the ground investigation part of the business. From a housing perspective, we acknowledge that this is at the lower end of our margin range, but has seen extraordinarily strong demand in the year. And that's reflected in the strong revenue growth numbers that you can see there. House builders have continued to use our product, SmartFoot, and the level of activity has been very, very strong in the period. We had a degree of concern that the building regulations coming in FY23 may slightly pause activities or subdue them, but actually what we've seen in the first quarter is a continued strong demand, and we're really delighted to see that continuing through into FY23. And the forward-looking work that we're starting to book now is as far out as sort of October, November, which is quite a good outlook for our housing division. Housing does get impacted by supply chain pressures, again, using high volumes of concrete for the beam structures. But overall, we've seen a steady and gradual margin increase, which is a high area of focus for the housing division. And finally, Strata, about 5.5 million of revenue of the 40 there is represented by our ground investigation business. And pleasing again that as we've announced previously, have a place on Highways England's GI framework, and have started to see some benefits from HS2 activity and doing more ground investigation work there. A good order book, as I say, carried forward, and we remain relatively optimistic there about the level of house building and use of our product. Not too much to say, I think, on the balance sheet. You'll see that we've returned to a much higher level of capital investment in the year, 4.9 million. We acquired 8 new rigs, which form part of that 4.9 million in the year, and again, typically focused on those higher margin areas of our group, making sure that we're investing in the areas that we think we can get the best levels of return from, and where there is market demand. Working capital has increased 6.9 to 8.1 in the year. We saw a large increase in the previous year as the markets returned back to normal, and this really just reflects a higher level of activity that we've seen in H2, but particularly in the fourth quarter. I won't go into too much details on the other one, but other than to note that it's pleasing to see that we're now in a net funds position, even taking into account IFRS 16 lease liabilities at the end of the period. And moving on to net funds, a few moving parts here, but there you have at the bottom left of the table a net funds position excluding lease liabilities of 5.9 million. We closed the year end with 7 million cash in the bank, and importantly during the year, two things. One is that we paid down the debt that was taken on through the acquisition of Screwfast. The transaction was done on a cash-free, debt-free basis, but we inherited a number of loans and hire purchase contracts. They have all been repaid in the period. And alongside that, and you'll see this on the next slide when we reconcile the cash position, we've also paid down the principal a further 2.9 million on our hire purchase contracts. So as we stand at the end of the year, we're sitting with the only remaining debt, if you exclude leases, of 1.1 million of hire purchase debt. I certainly wouldn't rule out that we would never take on any debt moving forward. Certainly hire purchases, it can be attractive for if we've got long-term capital requirements for our rigs, but I'm pleased to see that down at a really low level, and if you were to wind back 4 years, you would certainly see debt of 16-17 million on the books. So it's really pleasing that the company's managed to generate enough cash to pay down a substantial level of that debt. And the final slide is simply the opening to closing cash reconciliation, which I think we've covered off the key points. Obviously, there's the operating cash flow. You can see there the working capital investment or increase in the period. CapEx returning back to more normal levels, broadly aligned to depreciation, and they're a significant chunk of money in repaying financing. And of course, that final red bar will shrink now that debt is down to substantially lower levels. So, Mark, if I could perhaps hand back to you to wrap up.
Yeah, thank you, Graham. I think as I kind of summarised at the beginning, we've made good strategic progress. I think that's the thing I'm most pleased with. The results will follow these actions. I'm pretty confident of that. And a big part of this goes back not just to the year that we're reporting on, but prior year actions around improving, strengthening the management team, restructuring the organisation, co-locating our people in a more collaborative environment, and going into the market in a more confident, integrated way, as you should, as a sort of customer-focused organisation. And we had some work to do in all those areas. And I think what we've seen in FY22 is our teams starting to become more embedded and confident, having sort of made changes to their teams as well. And these things take time. Our rail director only started in January 2021, for example. So very pleased with the progress we're making strategically. Done a lot of work on the people front, as those first few bullet points make reference to. Employee engagement is improving year on year. Still loads to do, lots of development and training still that we want to do. We're about to launch our leadership program next month, for the first ever, and the first type of leadership training a lot of our middle managers have ever had. And we're trying to build for a sustainable long-term future with a succession plan of people that can really come in and keep the momentum going. I think the other thing worth mentioning is I can't overplay, I should say, the importance of our customer relationships and some of the bigger framework opportunities that we've got. Sometimes they look like major projects, but they involve multiple techniques and capabilities integrated onto single complex projects that 3 or 4 years ago we would never be considered for. We didn't appear to have the maturity as an organisation, the relationships, or we were siloed in the way that we went into some of the opportunities in front of us. So we never really gave customers enough confidence to team up with us on the bigger opportunities. Even though we were the biggest in the UK, we had an attitude that was a lot more small-minded. So the integration of Screwfast, the diversification of the additional capabilities such as sheet piling and minor civils and rigid inclusions, for example, all now fit into an organisation that's much more comfortable working together, offering the best integrated services to customers who can then see that no one else can offer them, which is what we've been striving for, because they can't. We are quite unique in what we can offer across the sectors and across the capabilities that we talk about. And rail is the best example of that. Nobody else can do what we do in rail and what we do on the ground. And when you put all that together on a Trans-Pennine rooftop grade, it puts us in a very, very strong position. So all in all, I'm very pleased, and that's supported by a much stronger balance sheet and financial position, which has gone hand in hand with the more qualitative improvements that I've just described. So yeah, pleased with progress. And then the next slide really just touches on current trading and outlook. Momentum's carried on into FY23. Happy enough with the work streams in front of us. I don't have any particular concerns about our markets dipping in the foreseeable future. We have still got some headwinds. Cost inflation and wage inflation are still big challenges for us. Our people are attractive for the purposes of poaching. High Speed 2 is going to represent a huge peak in industry output, which means that we need to be involved and stop people poaching our staff. And I think we've made good progress on both of those fronts. We expect to do much more on High Speed 2 in the next 2 or 3 years as things start to really sort of get going. And from inflationary point of view, we price it in quite well. From a materials perspective and wages and labour perspective, I'm probably more worried about making sure we retain our staff, because there are some silly prices or salaries being thrown around to poach people at the moment. But I think we can handle it. One of our most important strategies is growing from within and not being dependent on just recruiting in the open market to meet our growth. So we're going to need more resource. We have 36 apprentices at the moment. I want to up that to about 50. We've made pretty good progress on our apprentice programs this year, but we're gearing up It doesn't take long for these youngsters, and there's more girls in this company than ever, I'm pleased to say. It doesn't take long for them to learn, proving very useful after only a year or so. Order book's fine. We don't factor into our order book the framework contracts that we've been mentioning until we have a specific call-off contract for the individual jobs as they come through. So we don't try and factor in projected revenues from any of frameworks. That's very much secured work, and that's at a good level for us as a company. You'll be aware that we often only have 3 months or so of revenue secure, but a huge hopper of opportunities coming through, and constant contract awards and contract completions going through. We still deliver over 1,000 projects a year, bidding over 4,000 projects. We don't have a parent company who donates or allocates any work to us whatsoever, but we bid against all the guys that do, and I think that keeps us very, very competitive and hungry. So all in all, I'm pretty pleased with the way FY23's kicked off. Worth mentioning rail strikes, which we didn't anticipate at the start of the year. That we can work around those, but they're not helpful. So we're absorbing those as we go. So I didn't want you to think life was easy. We've still got lots to do this year, but confident and happy with the projections we've got in the marketplace. And this final slide really summarises how we're going to get from FY22 and also the expectations are out there for FY23 towards our medium-term KPIs that you're familiar with, listed here on the right-hand side. So really the most important two here are the 7 to 8% operating margins and also the 15 to 20% return on capital. So we, as I said earlier, know that we have several steps to take yet to achieve this, but we are moving absolutely in the right direction. And the opportunities that are listed in the top half of the slide, perhaps we've touched on many of them, but positive market conditions, a diversified business that's got a greater bundle of services to offer, a much more confident, strengthened management team, very strong customer relationships, but also long-term opportunities already secured, if not in our order book, that give us confidence that we've got step-ups from our normal workload towards the levels of work and upper margin contracts in the right sectors that will help us with that journey to those margin levels. We are constantly looking at additional bolt-on opportunities. The Screwfast acquisition has been very successful. The potential in Screwfast is all still ahead of us. Pleased with the way it's integrated. It's opening up doors for us in several areas. Instrumental in smart motorways, for example. It's now the foundation of choice in the smart motorways arena. So been very, very pleased with Screwfast. If we can find one or two more like that, then we'd be delighted, and we're certainly up for it. And some of the challenges and headwinds I've mentioned, I think we've got all of those under control, actions in place, and experienced people working on them. I'll draw particular attention to the transition between Cp6 and Cp7. I'm determined not to be in the position that I inherited, where we hadn't planned sufficiently for the transition from Cp5 to Cp6, and we're so dependent really on rail electrification in the UK that was paused, that our rail business took 2 or 3 years to build back to the levels of opportunity that it's now got, that some of you would have heard us talk about in our rail briefing back in the middle of July. We're well positioned really for the future. And part of our transition plan is the assessment of international opportunities for the first time. We're getting closer to moving forward positively, potentially in Canada. We're also been invited to negotiate a partner role in Northern Europe on a big electrification program. We'll see how those both pass our governance gateways. We're very, very clear on the commercial models that will be acceptable to us, but nonetheless, they are very, very exciting opportunities. And I think that's probably a good summary of everything that we're thinking about. A few statistics there for reference. I'll make particular mention of the final stat on that sheet, which just shows how much we're doing behind the scenes to develop our workforce, a doubling in the number of training days that we've delivered in FY22 compared to FY21. This is all in-house delivery, by the way. We have our own training business unit, which also sells training externally. That's all also being put under a completely new management team and is now going from strength to strength. So just a small example of one of many changes and improvements that we've been making. Good, thank you, everyone. I think we're finished with slides. Happy to take some Q&A.
Yeah, thank you, Graham. Now, if we could just turn to the questions. We had a number of questions submitted ahead of the presentation. However, please do continue to submit your questions using the Q&A tab situated on the top right-hand corner of your screen. Additionally, your feedback is important to the company, so immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback. While you're submitting questions, let us first have a look at a couple of those submitted ahead of the event, and one which is very topical, which we did have, was how are you preparing for diesel-free construction and the move to electric plant and vehicles?
Well, good question. We've got a lot of work to do here, and in fact the whole industry has as well. So we're part of the Federation of Piling Specialists, our sustainability plan aligns to the targets that the FPS has laid out for the industry. We sit on the executive committee of that, and we are aligned to the Construction Leadership Council targets for the industry. So that means net zero by 2050 and various milestones along the way. I won't pretend that we are leading the charge here, excuse the pun, in terms of electric rigs, for example, because they are an extremely expensive R&D exercise that we are not best positioned at the moment to be the pioneers in. We are supporting and very interested in some of our colleagues who are working on some of these ideas, which are substantially funded by customer programs, including High Speed 2, which are cost reimbursable. We don't quite have that same position at the moment, but we'll soon adopt the technology when it's proven. And that's the honest answer of where we are with electric rigs. Alternative fuels, absolutely, we're moving forward on that. And in terms of greening our assets and decarbonising our operations in other respects, we're doing quite a bit of work on cement replacement, on emissions on rigs, on solar powered facilities and workshops and yards. We've got a full sustainability plan with all sorts of commitments in it. But to your specific point, we aren't there with rigs, but some of our smaller components, such as mixers and smaller equipment, we do have now electrical power. So we have electrical drilling rigs for ground investigation, I suppose, just to cut to the chase, but we don't have it yet really for the bigger rigs.
Fair enough. Good answer. So next question from Mark A. Can you give a little detail about the Smart Motorways Programme framework? How big is this opportunity for the company?
Okay, yes, I can. I spend quite a bit of time with the team co-located in Birmingham with National Highways and our 3 Tier 1 customer partners, which are Balfour BT, a Morgan Sindel joint venture, and Costain, and 2 designers, and which is WSP and Jacobs, and as an organisation, that alliance is set for 10 years to retrofit all the existing smart motorways that need retrofit works, such as emergency refuge areas, which you'll be aware of, and deliver the new all-lane running and other new schemes that are planned, subject to the government answering the questions of the Transport Select Committee of last year. Right now, the Smart Motorway Programme is gearing up significantly to start all of those retrofit works we are starting work before the end of this calendar year on the northern sections of the program up north on the M1 junctions 35 to 39 to do emergency refuge areas along that route, and then that rolls out for 5 or 6 years at a level of work that we assess to be circa 15 to 20 million per annum to us, before the new schemes, which are the M3, the M40, M42, and the M62, and after that the M25, hopefully all start on top of all of that in 2025 when the data collection's been done, which is what this pause is all about. Before all of that, ongoing schemes such as the M6 21 to 26 are allowed to proceed, and we are solely delivering that already on site. So in summary, we're already busy. We will get a lot busier at the end of this year when the emergency refuge area works commence, because these are not simple geotechnical schemes. They all require quite a lot of work. Our team is gearing up. We share the work with Balfour Beatty Ground Engineering, but I'll be honest with you, we have significant head start because we have screw fast, we do sheet piling, we have road rail vehicles that we put onto the smart motorway environment, which are unique. We can do stuff that no other company could do. So I expect us to do very well, and we should plan on the basis of 20 million of annualized revenues on top of our core base workload coming from the Smart Motorway Alliance, which is what we've mentioned in our statement somewhere.
Great, thank you. Quick question from Doug D, and this is following on from your reference to the training department. Can you talk more about the external training, please?
Yes, so right out here, our training centre in Kirkby is a building that we invested in 2017 with 7 modern classrooms and an outdoor training area, which is effectively sized to do plant training, accredited to CITB. And what we offer externally are the same courses that we offer our own people, plus other courses if there's a demand for it. So we deliver plant training, safety training, NVQ competencies. We run apprenticeship programs, streetworks training, all for external companies in the region that want to buy that from us. We provide commercial rates into the market. We have a web-based system where people can book. And if we have capacity, we mix external delegates in with our internal delegates. But the priority is our internal training, but we've got additional capacity that we want to make it at least a profitable enterprise. And so we're now delivering reasonable revenues externally. And coming out of COVID, we expect those to increase quite considerably over the next 3 years. And it's a small part of our margin improvement plan because it is high margin, low risk work where we've already built the infrastructure. So we're making the use of the assets.
Right, okay, well, you touched on margins, so this next question is relevant. What are the key factors driving your ability to enhance margins?
I could answer that, but I'm conscious Graham probably wants to also jump in, otherwise I'll just talk non-stop. Graham, do you want to explain our thinking here?
Sure. I mean, I think the enhanced margins we've got at the moment. Mark's already touched on the headwinds that we're facing with supply chain. I mean, clearly market expectations are that they won't be around forever, and as the market returns to normal, there's some opportunity there. But the big value really, the big opportunity really for us is when the mix returns. From at the moment, what we're seeing is extremely strong demand in the residential sector, which is the bottom end of our margin mix range. Really good business, by the way, and the teams are doing a fabulous job in delivering the work. But ultimately, we've got very niche capabilities in supporting the infrastructure networks. And when you look at rail and smart motorways work, where we've got a very specialised skill set, there's a real opportunity with a good, strong market outlook for future works. And as that work picks up, and we invest in more capability to grow that work even further, then I think there's a real opportunity to rebalance the mix of work into that area. And then the final piece in this puzzle is a bit of self-help as well, really, in terms of looking at, for example, our production capability. How do we produce piles in our pile factory more efficiently? How do we get the right capacity output? And again, we're looking at programs to maximize efficiencies there. What's the best way to buy beams for our SmartFoot business in housing? Do we buy them in externally? Do we manufacture? And we're looking at all of those opportunities to maximize our internal, minimize our internal costs. And it's referred to in the strategy slide that Mark talked through as well, which is a lot of self-help programs in terms of progress around bringing ourselves into the modern era of automation and efficiencies. We still do a lot of work because the group has grown so quickly. It's grown through using systems like Excel, like many businesses face those sorts of challenges. And there's a lot of automation we can bring to the business to really drive better efficiencies.
Great, super answer. So this may be slightly harder to pinpoint, but Mark A has asked, where do you see the greatest potential in the business?
Well, it's a great question, that, because I see really good potential genuinely in every single division, I'm pleased to say. There's not one that I think is a laggard. And I might surprise you by saying strata, because it's easy to say rail, because rail will grow significantly. Screwfast will, I think, triple over the next 3 to 5 years, and has tremendous margin potential and is opening up doors for us in other areas. Those would be easy answers. Strata is often slightly overlooked, questioned in terms of does it contribute enough to the group? But strata is the front end relationship that we create when we get involved in ground investigation, and in rail, it opens up the door for us to do a lot of follow-on works. But we've now negotiated, we'll do all the ground investigation on the Smart Motorways Alliance for 10 years, which hasn't started yet. We're bidding for phase 2 of High Speed 2 ground investigation framework. The margins in strata are easily as good, if not slightly better, than those in rail. It's just that it's a bit small. And I know I've been saying this for a couple of years, but if we can scale up strata from 5 to 6 million to 8 to 10 million, and maybe that may by a little acquisition along the way, and we have looked at a couple, then I think strata could really contribute massively in proportion to its size, very well to the group. But I'm just as excited about all the other divisions as well. They've all got tremendous potential. And what's really pleasing, and where the real potential of the group comes through, is where we integrate those services seamlessly in front of a client who's looking for a one-stop shop and a partner. So a perfect example of that would be one of the big highway schemes that we're looking at the moment with BAM Nuttall. We're their preferred partner. Touchwood, for the A38 going all the way through Derby, some of you might know it, where we'll do almost all the different specialist techniques that you need to do on a highways job, including the rail interfaces, all under one project director with one integrated team that makes the whole experience for BAM much easier than you have to use multiple parties. And we solve their geotechnical problems as we go along, because we kind of embed in their team and co-locate with them. And that for me is a perfect, that we're doing that more and more now and being asked to do it. And usually they start by saying, are the Screwfast team still there that we used to know a few years ago? And if they are, can they come in under you as well? And that's absolutely perfect. 3 years ago, we wouldn't have had we wouldn't got anywhere near anything like that. And that'll be a £20 million program on the A38. We're going to do something similar with Costain on the A12. And to some degree, the smart motorways are a bit like that as well, albeit it's more sort of stretched out over time. So I don't know if that answers your question, but
very comprehensive, yes. So yeah, very encouraging indeed. So before we go to a closing summary from you, Mark, maybe we can just touch on this last question, and you have referred to it already in part, but I wonder if you could just add a little bit more colour, because the question is, can you update on your international ambitions? And I know you've got one particular Canadian opportunity that potentially illustrates how that might how that might work.
Yeah, so we've been, for the last 12 months, looking seriously at suitable international opportunities that might fit our commercial expectations and risk tolerance, with a view to making sure we don't suffer a dip in from Cp6 to Cp7 by solely relying on the UK sort of unreliability. And our sort of assessment, we've been involved and talked to lots of parties and customers. Our top priority at the moment is Canada. We've been invited to become the embedded foundation partner for the Toronto Metro expansion with the winning consortium of Canadian firms who are populated by Brits that we happen to know. And our rail director, David Buckley, knows the Canadian market very well. And, you know, where we are now is we expect to agree a consultancy agreement to support them for the next 12 months, build up a price and a plan, give them all the advice they need on a reimbursed basis. And then if the commercial terms and the price is right, we will potentially go forward, subject to board colleagues all agreeing with that outcome if we get that far. And that would be construction in 2024-25. Commencement might be there for 3 to 5 years. And in all likelihood, there'll be a snowballing of other wider interest in Canada when we get there, because we offer techniques and engineering innovation that can't be found elsewhere in the world. And I'm not making that up. Some of the stuff we've pioneered in the UK is market leading in the UK, but actually the UK is 10 years ahead of other countries in terms of on-track delivery of complex foundations. And the other area we're looking at is Northern Europe. We've been asked to do something similar on a big electrification program outside Copenhagen. Again, several hurdles to go through before we're satisfied that might be acceptable, but that's the other one we're investigating closely and doing some pricing support work for them.
Great. Okay, very encouraging indeed. Thank you, Mark. Thank you, Graham, for updating investors today. Could I ask investors not to close this session, as you will be automatically redirected for the opportunity to provide feedback. Equally, if anyone has further questions or would like additional information on VanELLE, please do get in contact via vanelle@walbrookpl.com. But Mark, could I possibly ask you just to give us a closing summary, a little 20 seconds or so on the outlook?
Yeah, look, I won't repeat myself. Very happy with where we've got to. The journey's only half done. I think we've got a good foundation for moving forwards to the next phases of our improvement. We've set out our targets for FY25. We're increasingly confident of achieving them. I think the building blocks are in place. Very pleased with the team, very pleased with the culture change in the organisation, most importantly, that supports that. So, you know, looking forward to giving you further updates.
Great. Super. Thank you all, and thank you everybody for attending. We look forward to updating you soon.
Thank you. Thanks, everyone.